It's generally pretty risky to forecast low volatility in the oil markets. It's a very volatile asset, but we have been forecasting a range for Brent, 70 to 85, and we continue to stick to that range. Two ways to think about this range. Number one, we think this range is essentially what OPEC is aiming for. They have been defending 70 as a floor, and they have been signaling production increases when Brent was in the low to mid 80s. And then on the US side, there's a lot of focus on the fact that President Trump wants to support energy affordability, which in our view means Brent below the mid 80s. That corresponds to the emotionally very salient $3.50 per gallon threshold. But on the flip side, US energy dominance means that prices need to be above 70 for US supply to continue to grow.
That's a great, I mean, you've chucked in so much more. I'd make it 3D, and the lack of Chinese demand might be another factor. But where do I start? Okay, defending 70 isn't good enough for OPEC because their budgets, as you know far better than I will ever know, $85, $90, $95. To balance the books fiscally, they need like $90 plus. Defending 70 sounds like waving the white flag.
So mechanically, it's correct that for the balanced budgets to be realized, you sort of need Brent in the 90s, perhaps low 100s for Saudi Arabia. But I think that's perhaps a little bit too simple of a concept. Yeah. Number one, they can run deficits. True. Number two, the debt to GDP ratio is still quite low, around 30% for Saudi Arabia. And third, there is flexibility. You can postpone capex plans. You can raise taxes. Tax rates are still quite low in the region. And so, yes, ideally, prices would be closer to the triple-digit threshold. But we think 70 to 85 works well for the key core OPEC countries.
Can I ask you about the transportation side and oil? Because we had the ACA numbers today. Battery electric vehicle sales grew 34% in January. There was a hybrid mix there too, up 18%, which tells us that there's still appetite for EVs, which is quite different to what last year we were talking about fading demand. How is that transportation segment catching up with the demand story?
Yeah, so the transportation sector is crucial for oil demand, about half of global total oil demand. We estimate that the rise of EVs, about 20 million EVs are being sold per year, is subtracting up to 0.4 million barrels per day of annual growth. But the data suggests that you're surprising to the upside in terms of EVs in China, but disappointing in the US and many other markets. In fact, we reduced our forecast for EV sales pretty significantly on the back of the Trump election and raised our 2030 US oil demand forecast by 300 kbd on the back of a slower transition to EVs.
Fascinating. So there is a policy impact there. I want to pick up on gold because that's where the Trump administration has impacted the price action too, the disconnect between the London Exchange and New York, where there seems to be stockpiling. You've added central bank buying into the mix as you change your forecast for this year. Just talk us through the mix of elements that has seen you raise that forecast on gold for this year.
So we continue to consider gold as our favorite long commodity exposure, both because increased central bank buying, and central banks are buying 5 times more than before the freezing of Russia's central bank reserves in 22, is going to continue to push up demand and push up prices. And then from a speculative positioning perspective, as long as US policy uncertainty and inflation uncertainty remain high, we think that spec positioning, investor positioning will remain stretched. In our base case, we assume a normalization in spec positioning. If policy uncertainty and spec positioning remain high, we would be forecasting $3,300 per troy ounce by year end versus our base case of $3,100 per troy ounce.
Things worry me when they go up very, very quickly. The trader part of me says, what about the opposite side of the trade? Well, we are hearing discussions around some sort of resolution around the war in Ukraine. If that were to happen, wouldn't that take away a huge geopolitical premium and potentially cause some flight from gold?
One potential bearish argument against sort of the central bank purchases are pushing gold prices higher argument is indeed that perhaps Russia's central bank reserves that got frozen may be unfrozen in the context of a resolution of the conflict. But we think that central banks learned in 2022 that treasuries are not necessarily a safe asset. We crossed the Rubicon. It was a wake-up moment. And I think central bankers will keep this in mind and continue to increase. They're still fairly low gold share of their reserves. So we think this is a structural bull story that will continue.